This video is called Enhance Yield by Selling Put Option Premium. One of the biggest challenges facing investors of retirement age with typically heavily weighted bond portfolios is the current low income yields that bonds provide. In addition, bond portfolios are subject to significant risk in the event of a transition into a rising interest rate environment. Most people equate bonds with low risk, but the sensitivity of bond prices to a change in rates, called duration risk, is higher when rates are low, so the risk of bonds is actually higher than they normally are. So bear that in mind. So for investors who require yield or income from their portfolio, using this strategy of selling put option premium on equities opportunistically can provide attractive yields in excess of bond yields, and so we will walk through the mechanics of implementing this strategy. There is a detailed article explaining the mechanics on our website, and where you can also copy the spreadsheet needed to implement the strategy if you wish to do it yourself. So check that out. How it works: you begin by having your regular bond portfolio that would function in the normal way. However, if opportunities arise, and the key word is if, to write put option premium on stocks that we have pre-qualified and where the risk-return ratio meets our strict guidelines, then we will reallocate the capital from bonds to the put option strategy for that opportunity. That is, sell our bonds to invest in the put option strategy. So what does it entail when you sell put option premium? By selling put option insurance or premium, you are collecting a premium upfront in exchange for agreeing to buy the stock at some agreed upon price, usually lower than the current price, in the future. If the stock does not go below the agreed price within the term agreed or the time period that you sell the insurance for, then you get to keep the premium and the trade is over. If the stock price goes below the agreed price, then you will be required to buy the stock from the person who bought the insurance from you. So your risk is that the stock price falls below the agreed strike price and end up having to buy the stock at a higher price than you could resell it for. And so for this reason, you only want to sell insurance on stocks that you are willing to own and hold for the long term, because you may end up owning them, albeit at a lower price than they trade for today. And so this is an example that we show in our article for Intel, and this was done a while back. The stock was trading at $33.84 and paid a 96-cent dividend, so the dividend yield was 2.84%. The yield on investment grade bonds at the time was 3.42%, and so we looked at the opportunity to sell put option premium at a price 10% below the current price, what is referred to as the strike price, which would be $30.46 or $31, which was the closest available strike price. And we went out 9 months, which meant the days to expiration was 253, which is 70% of a full calendar year. Now, the price of that option was $1.64, so we could collect $1.64 today, and you would need to secure your commitment to buy the stock at $31. And so you would need to put up 31 minus 164, so you would put up $29.36. And if by the expiration date, July the 15th, the stock was above 31, you just get to keep the $1.64 premium, and that will give you a yield of 5.95% for those 253 days, which on an annualized basis equates to 7.95%, and that's shown on line O. And that turns out to be 4.53% more than the yield on investment grade bonds. Now, let's assume the stock price goes below 31 and you end up having to own it. Then you have already put up the money, so you own it now at a price of $29.36, and you will now collect the dividend of 96 cents, and that will provide a yield of 3.27%, which is slightly less than you were getting on investment grade bonds. You can decide on a suitable premium for your risk appetite for each of the two possible outcomes. My recommendations are shown by the green boxes in the spreadsheet, which are: if the trade goes in your favor, you should earn at least an annualized 5% yield greater than you would have earned on the benchmark investment grade portfolio because of the additional risk. And on the other end, if the trade goes against you at the time of expiration, you should end up owning the security at a minimum of a 15% discount from today's price, and with a resultant yield which is at least as good as what you were receiving on your bond portfolio. So even if it goes against you, you still have the same income coming in from the dividends as you did from the bond interest. In this case, the trade did not meet the criteria, but it was close. And so take a look at that in our article, which explains it in more detail. And then managing the risk, there are a few things to look out for. We must be comfortable owning the stocks we sell insurance on, so you have to do your underwriting or research. Secondly, however much you allocate to the strategy, we don't recommend putting more than 15% in any one stock. The other thing to monitor is the implied volatility of the stock you sell insurance on. We say it should be at least 20 to 25% above its 12-month average historical volatility. This is what historical and implied volatility looks like in a chart. It's generally range bound. The implied volatility determines the price of the option premium. When it's high, you get a higher price, so you want to sell premium when volatility is above its average. You don't want to sell premium when volatility is at its lows. Third, we recommend you use government bonds for the strategy because generally when opportunities present themselves is when equities go down, and that is when government bonds generally go up. So it serves as a nice rebalancing mechanism. Lastly, the key takeaways on this. It can be a productive strategy, but it is a little sophisticated and does require research and being prepared for when opportunity presents itself. While the put option strategy may be more risky than bonds, when viewed in light of the lower reward to risk ratio of bonds at current low interest rates, it is worth considering substituting the put option strategy for a part of your bond portfolio under certain conditions to enhance your yield. So that's it. We've tried to make it easy with a spreadsheet. So if you're up to it, read the article and give it a try. Thanks.